Hello, everybody. I'm Matt Garrett, CEO, founder of TGG Accounting, and today we are going to talk about what to do in a rising interest rate environment.
Before we get started, make sure you click on the subscribe button, and if you're on YouTube, click on the alert notification so you can be notified when we post new videos.
Interest rates are going up. They continue to go up. They're probably going to continue to go up for at least another 6 months to a year, maybe even as much as 2 years. The Fed has completely said they're 100% convinced that they need to get back to 2% inflation. We are at 8.5% right now. Even if inflation reduces itself by 6%, we're still not there for their target, which means we still have to get to 2.5%. So they're going to raise interest rates until they see that we're going to get back down to 2% inflation. That could be a long haul. So get ready, pack up, and get used to this new interest rate environment. And what is it going to mean for you? Well, it means a couple things. With lines of credit, we need to rethink whether or not using the line of credit is an appropriate source of funds. Lines of credit are short term, and they're meant to cover things like, I need to hire a bunch of people. I have to pay them now, but I'm not going to collect until here. And when I do, I'll collect profitably and I can pay off the line of credit. Hence the term revolving line of credit. This is typically going to be something that makes a lot of sense. But as interest rates rise, you have to start thinking about it in terms of your pricing when you're going to work with your customers on terms. If your customers push you out 90 days, 120 days, 180 days, you've got to think about what that interest rate effect is on your line of credit and price it in to your product and price it into your service and price it into your contracts so that you're making sure you're not losing money on these deals when you've got this increased interest rate. The second thing you need to be aware of is renewing these lines of credit as soon as possible will really help you forecast out what that's going to look like for 2023 and beyond, because it's important that we understand where we are and you can start to business plan and price and do all those other things, knowing that you're going to have to borrow on it a little bit. The third thing that's really critical is using a line of credit properly. Line of credit is for short-term financing. If you have gotten in a situation where your line of credit is constantly tapped, you're probably not using it correctly. And you might want to think about other forms of credit. So things like operating loans from the SBA, stuff like that, that you can fix the interest rates and you don't have to worry about them going up or down next year. If you've got a long-term need, put long-term financing in place. Short-term need, short-term financing. Lines of credit or short-term financing, other types of loans, long-term financing. It's the easiest way to make sure you're not negatively impacted by these rising interest rates.